Welcome back. You're watching The Money Show with me, Kavita Thaplial, and that part of the show where we answer viewer queries because there are a plethora of funds available in the market to invest your hard-earned money in. But how do you assess which is the right fund for your portfolio? What are the criteria that one should look at to help you navigate through this maze? We have Pankaj Matpal, MD, Optima Money Managers. Also, do not forget to send us your portfolio queries on our WhatsApp number, which is 865-797-4571. You can also email us your queries on themoneyshow@etnow.tv. Good evening, Pankaj, and welcome to the Money Show. And let's begin the question answer session. I have Mr. Vinay MR's question first. He says that he's retiring and has 1 crore corpus amount. He would like to know the avenues where he can invest this amount for almost 8% guaranteed regular returns per annum, with principal being safe at the same time. So clearly, this is his entire retirement corpus that he's collected, and he might want to use this for his post-retirement life and also have a regular income from this investment. So no risk investment instrument right now, that is something that you might want to suggest?
Kavita, good evening. Because he has clearly mentioned that he wants something where the principal is safe. So first thing is senior citizens savings scheme. For senior citizen, this is one of the best schemes available in this category where your principal is safe and returns also, because right now the rate of interest is 8.20%. And if he invests in this scheme now, the rate will be locked for next 5 years. The maturity is 5 years of this scheme. So interest is paid on the quarterly basis, and the scheme is available in designated post offices plus government banks, public sector banks, and as well as few selected private sector banks. So he can deposit up to 30 lakh rupees in his account. And if, for example, a spouse is also a senior citizen, in that case, additional 30 lakh can be invested. So that is one choice. Apart from that, there are Government of India floating rate savings bonds, which are issued by RBI on behalf of Government of India. These have a floating rate interest, but as of now, 8.05% is the rate of interest applicable. But that is reviewed every 6 months. So maybe it may be a little lesser or more, but that is another choice where the principal is safe and it's a government-backed scheme. So he can invest in that. There is no upper limit. But as a suggestion, if he can take little bit risk and some part of his portfolio he wants to invest in mutual fund, then some conservative hybrid funds or equity savings funds are available. But because he's not available on the phone, so I can't comment much. But as capital is not protected there, but to beat the inflation, one must consider a small part of portfolio at least in some equity-oriented schemes or some hybrid scheme. So that is also one suggestion. But as he had mentioned that he
Pankaj,
wants
just talking
something
about
where
senior
capital is
citizen
protected.
savings scheme. So Pankaj, just talking about senior citizen savings scheme, how can you ensure that you have regular income via this investment instrument? Is there a facility where you can decide monthly income or maybe quarterly or 6 monthly?
Kavita, see, it's only a quarterly option. Your interest is paid on the quarterly basis, and you cannot change it. But as you know, if you need monthly cash flow, you can keep that in your account, or you can use as it is. But from the government side, that is paid on the quarterly basis only.
Right. Any other safer instrument that you might want to recommend to him? Maybe a debt fund or anything similar to that he can maybe have his investment also going. Some part of it may be in equity, as you also suggested that if he can take a bit of risk, then maybe a balanced fund would be good for him where he can have a SWP.
Kavita, see, one thing I suggested that Government of India floating rate savings bonds. So that is another choice where the capital is protected. But as I mentioned, not even balanced fund, if we can invest in some conservative hybrid funds or equity savings funds. Why I'm saying this? Because he has clearly mentioned in the email that he wants capital to be protected. In mutual funds, whether it's debt funds or equity funds or any kind of mutual funds, neither returns are guaranteed nor the capital is protected. So considering that fact, I mentioned, and you also you said the same thing. He should have some exposure in equity through hybrid funds or through any funds, or at least debt-oriented mutual funds, as you mentioned. But the fact is that he should know his risk appetite. If he can take the risk of volatility, he is comfortable with this, then only some part he should invest in mutual funds. But from my side, I'll say only one thing: to beat inflation in long term, one should have some exposure to equity.
All right, we move on. Our next question is from Chandan Jain, and he wants to invest 50,000 and that too a tax saving option. He wants to know about ELSS fund. So let's just begin with the kind of tax benefit you have in an ELSS fund, and how is an ELSS fund different from a normal or a regular mutual fund?
See, Kavita, first thing, these are equity fund essentially, so invest in equity only. So you can say these are kind of flexi cap fund because there is choice to invest across the market segments. But it depends on fund, from one fund to another fund, that where they have allocation. And most of the funds have major allocation in large cap, followed by mid cap. And tax saving under Section 80C of Income Tax Act, the taxpayers get the benefit of deductions, but that is available only under old tax regime. So if you are filing your ITR under old tax regime, then only you can claim deduction on these ELSS. Second thing, there's a limit of 1,50,000 under Section 80C of Income Tax Act. So it is a combined limit. So maybe that you are paying your children's tuition fees or principal amount of home loan, or you have already invested in PPF, or you are contributing to employee provident fund. So put together, the limit is only 1,50,000. So that you have to keep in mind. Now coming to schemes, I'll suggest two schemes here. One is Motilal Oswal long-term equity fund. Another one will be Mire Asset Tax Saver Fund. So these are two schemes I can suggest him, and both are very good scheme. Only difference is that Motilal Oswal long-term equity fund, it has a focused approach. It has a little concentrated portfolio, but this Mire Asset Tax Saver, it has around 66 stocks in the portfolio. So it has a diversified portfolio. But both the schemes have consistent performance, history, and good portfolios.
All right. Considering now these funds have a lock-in of 3 years, should you be going the lump sum way or an SIP way? And if at all you are going to an SIP way, how to make sure that each of your SIP installment completes 3 years of time before redeeming it?
Yeah. Kavita, the most important thing is if somebody wants to take benefit in the current financial year, so definitely they have to invest the amount before 31st March 2024. Means on the amount what is contributed in this financial year, that will only be eligible for taking benefit for income tax. Second thing, if you invest through SIP, because lock-in is 3 years for the units from the date of allotment. So if suppose you invest from now and you expect at the end of 3 years from now, you want to redeem all the units, that will not be possible. Only units which have completed 3 years, those can only be redeemed after 3 years. So in that case, for example, you're investing for 1 year, and after 4 years, you redeem the first 1 year contribution. That could be possible. So considering that fact, it will be better if investor, they go for the lump sum investment, if that is possible for them cash flow wise, and otherwise means they should invest in such a way that after 4 years they invest the first year total investment, or otherwise most important or the best thing is that they should link this investment to their long-term financial goals and should not think about redeeming after 3 years. So after a few years, after 10 years, 15 years, whenever the goal is achieved, that time these units will also complete that lock-in period, and then they can redeem those units.
All right, let's move on. And the next question comes from Anil Mehta. He's asking, how is HDFC Sanchay Plus as an investment to save tax? So what kind of a retirement plan or an annuity plan is HDFC Sanchay Plus, if you might just want to spend a few minutes on this product?
Kavita, this HDFC Sanchay Plus is a non-participating, non-market link plan. Means it's not a market link, and second thing, there's no bonus. it is a guaranteed plan. But when we say guarantee, we have to see that how much returns you are expecting here. And I expect a yield of around 6% with this policy, depending on the age. So 6 to 7%, if you say even, then it is not very high in the long term. So I think that for tax saving, this is not the good choice. If you want something where your capital is protected, better you go for PPF, because ultimately limit is only 1,50,000 to claim deduction under Section 80C. So whether you invest in Sanchay Plus or you invest in PPF, the limit is only 1,50,000. And considering that fact, my suggestion will be PPF is a better choice. And otherwise, as we were discussing earlier about ELSS, if you have a longer investment horizon, though lock-in is only 3 years with ELSS, but as you are investing in equity, so ELSS is a good choice for tax saving.
What's the tax treatment for HDFC Sanchay Plus?
Yeah, see again, here the because from this year we know that your contribution up to 2,50,000 rupees, premium of 2,50,000 in one financial year, returns on that will only be tax free, and amount exceeding to that, when you get maturity of that, that will be taxable. So from that angle also, now these tax in these insurance policies are no more attractive.
All right. So, what if you could just give us the normal range of premium for these kind of products, and what could be like the sum assured that's promised to you, and also because it's an annuity plan, right? So, how do you get annuity after investing in such products?
See, there are multiple choices. It's not a pure annuity plan, actually. It's a traditional insurance plan. And you have multiple choices here, whether you want a lump sum maturity benefit or you want to spread it over a period of time. So that choices you can opt for. And second thing, you said how much premium, how much this thing sum assured. That depends on age. And you have a choice that how much premium you want to pay. It's not like that based on the sum assured, you have to choose the premium. But this is basically a saving plan. So as much as you want, you can invest in such plan.
Would you also recommend, along with ELSS, would you also recommend a senior citizen savings scheme?
Yeah, for senior citizens, definitely that is one of the good choices, sure. Because ultimately returns are good at this point of time. You are getting 8.20% rate of interest, and plus it is a government-backed scheme and 5-year lock-in. But only thing is that it is available only for senior citizens who are 60 years and above. So otherwise, if you are taken VRS, then the age is 55 years. So not everybody can invest in those schemes. But for senior citizens, definitely they should think about that.
All right, let's move on. And the last question of the day, this is, okay, I don't think I have the name of the viewer with me, but he says that he's 40 years old and he's a government employee and he's doing 17,000 SIP, HDFC Retirement Savings Fund, Parag Parikh Flexi Cap, SBI Small Cap. He also has Tata Digital India Fund, Kotak Blue Chip, Kotak Emerging Equity, Franklin Smaller Companies Fund, Franklin Build India Fund. And he has 25 lakhs corpus and he's going to retire in Jan 35. How much money can he expect from his investments? And also he has investments going on in NPS and the amount so far is 10 lakhs.
Kavita, considering this 25 lakh corpus plus the 17,000 rupees per month SIP, if we calculate at the CAGR of 12%, so he can expect around 1.36 crore at the time of his retirement. Plus he has contribution in NPS, and in NPS it depends that what is the underlying portfolio, because the subscribers, they get choice whether they want to stick to default option or they want to invest more in equity. So depending on that, if I calculate at 8%, because I do not know the allocation, so I'm calculating at 8%, so he can expect around 2.38 lakhs with his contribution. I don't know how much he has already accumulated, but considering that what he's contributing now and what he has in his portfolio right now, So based on that, I'll say that he can expect around 2.38 lakhs at the time of retirement. And as we know in NPS, up to 60% of the total corpus can be withdrawn in one lump sum, that is tax-free, and minimum 50% has to be utilized to buy annuity. So that will be available with him. And as far as mutual fund schemes are concerned, though he has 8 schemes, and in each category he has more than 1 schemes also in some categories. But the schemes are good. He can continue with these schemes. Only concern that he has 2 small cap funds and also 2 sectoral or thematic funds. So as he is near to his retirement or after 5 years from now, he should switch from equity funds, especially from these sectoral funds or from small cap funds, to less riskier funds like debt funds or conservative hybrid funds systematically.
All right, I think that will be all for today. Thank you so much, Pankaj, for being on the show and helping our viewers with their financial portfolio queries. And time to sign off, but then I'm going to leave you with our mobile number, our WhatsApp number, and our email ID. So you can send us your queries on our WhatsApp number, which is 865-797-4571, and email ID is themoneyshow@etnow.tv. Thank you so much for watching. Goodbye.